Good morning, good afternoon, good evening. Thank you for watching. This is Michael Zitworth, One Rental at a Time, and I'm back with legendary investor Greg Dickerson. How you doing, sir?
I am here. Michael, how are you?
I'm doing very well, man. Thank you for doing this. As always, every week you got an amazing playlist. I don't know if people realize there's over 100 hours of you and I talking over the last year and a half or almost 2 years together. So pretty amazing stuff. We are about to disagree, which the audience always loves. So I put out a live stream yesterday talking about, or really putting out stats, because there's a channel that's talking about 2021 is just like '06, and that we are about to experience the biggest crash ever. Get out now. I disagree with that. And we did just a very short talk beforehand, and you disagree with me. You think we are in the greatest residential real estate bubble. So I thought we should talk about it because I'd love to see where I'm wrong.
Well, first tell me about what you're describing, because number one, '06 is interesting to me in terms of that versus '09, because the crash was '09, and that was actually a bigger bubble, higher valuations than the peak. My market was '04, '05. You want to call it '06. It may have peaked '05, '06 nationwide.
Yeah.
But values were higher in '08, '09 than they were in '05, '06.
Yeah. Yeah, I don't know. I used the year that this gentleman chose, '06. I looked, and the highest statistical number for housing prices was '06. It was like October of '06 or something. Like,
Okay.
again, we're
Well,
talking
maybe,
nationally.
yeah.
So these are
Okay.
national numbers, not local, because once you get local, all game's over. So national housing market. And basically the story is get out now. And when
Okay.
I did a bunch of research, right? Because I was like, what am I missing? So I looked at 2021 to '06, and I collected like 10 or 11 stats, and I'll just go through them quickly with you. And first, available inventory, right? As you know, we have a housing shortage. So we have about 1.3 million homes available for sale today. Back in '06, 3.7. So we had roughly 3 times more available homes that year. Another one that was interesting was housing appreciation from '04. So '04, '05, '06 was a whopping 48% nationally, which is way unhealthy. 19, 20, 21, as of right now, that's 24%. So we did have a big last year at 15, but right now it's half that. This is a big one for me. 30-year interest rate, 6.41%. Today, 2.88, and probably going lower. Another one for me is I'm a big believer in generational trends. So in the median first time home buyers 31. So I did math. 2006 minus 31 is 1975. So we had 3.1 million births in 1975. 2021 minus 31 is 1990. We had 4.2 million births. This does not include migration, which I didn't research, but I should have. I'm guessing migration is higher now. These are also some bigger ones that really drive me crazy because I experienced the run-up. I'll actually ask you this question. In 2006, of all the mortgages originated, Greg, do you know what percentage of them were adjustable rate mortgages?
Yeah, probably more than half.
It was exactly half, 50%. Great guess. Not many people get that. Here's a crazy one. Neg AM loans. Remember those pay option arm loans? You know what percentage they were?
25%.
Yeah, just a crazy number. So if you fast forward to today, so again, 50% of mortgages were ARMs in '06. Do you know what percentage they are in 2021?
I'll bet you 5%.
2.2.
Mm-hmm.
Yeah. And guess what percentage of neg AM loans we're doing today?
Oh, less than 1% probably.
0. They're not allowed.
Yeah.
they're illegal. What else do I want to talk about? Let's do the last two. So average home price in '06 peaked at 243. Again, nationally speaking. Today it's 287. So it's higher. But when you take those payments or take those values and then you put in the interest rates we talked about earlier, 6.41 in '06, you got to do apples to apples. So I assume 20% down. So based on a 243 purchase, 20% down, the payment's roughly 1,200. 287, which again is higher value, 20% down, lower interest rate, your payment's actually 960. So your payment's lower today, even though the price is higher. So that's just sampling of the data I collected to show that what 2021 is not '06. My big argument is twofold. One, what I experienced last time are once the values got hit, all the adjustable rate mortgages, especially the neg am loans, started causing huge pain, and it just dominoed. You couldn't get out of the way. We don't have that today. There's very, very little adjustable rate mortgages happening today. And oh, by the way, our payments are lower. And I didn't even do this. I should have. Your incomes have to be up in 15 years. So again, nationally speaking, I see a rather healthy real estate market. Now there are bubble markets, which we're not going to debate that, but nationally speaking, I do not see a housing bubble today. We could be forming one. We could be at the early start, but I don't see a bubble today. So that's kind of where I'm coming from.
Yeah. So if we're looking at it from a national standpoint, yeah, that makes a lot of sense. You know, '06, I guess values were higher at that point than they were in '09. And I do remember the peak of our market was '04, '05.
Yeah.
Then it tailed off from there. And I remember stuff was going up like crazy. So 40% is easy to believe. And remember, I remember interest rates were over 5% back then, and pay option arms were, you know, new. Interest only LIBOR loans were new.
Yeah.
You could get loans based off LIBOR for the first time back then. That's when they started '04, '05. I was using a lot of pay option arms.
Yeah.
You know, where you could select your payment, either low interest amortized or negative amortized.
Yeah, people may not even know what those are, right? Again, an AGAM loan, in my experience, gave you 4 options: full payment 30 years, which means principal and interest; full payment 15 years, principal and interest only, and then they selected a neg am loan, which just to say the full payment was $2,000, they would say pay $1,000 and we'll stick the $1,000 on the back end of the loan. So again,
yeah, it was called minimum payment option, and it was really, really low. And then it's, you know, basically think about a minimum payment on a credit card, you know, kind of works the same way.
Exactly.
Yeah.
Yeah.
And so those things were popular. And then, you know, things tailed off, you know, interest rates went up, the market started dipping. And I remember we had a little lull between '06, '07. And then it started shooting back up again before the crash in '08, '09. So we had about a year there where it kind of cooled off before it went back up. So values did dip a little bit. And that's why I tell everybody is really it took us until 2017 to 2018 to get back to '04, '05, '06 levels.
Yeah, values.
Right.
Yes.
Values. So we really didn't reach those values. And based on what you just said, that's about right. Because if we're up, you know, 20% from where we were, you know, in terms of gains in '06,
exactly,
then, you know, that makes sense. So it's taken that long. So we really are, from a value standpoint, probably at a healthy level based on normal expected rates of appreciation in real estate. The problem is what's skewing it, like you said, certain markets where, you know, values are up 30, 40, 50% or more, you know, for certain houses in certain areas versus the national average where it's only up mildly. And then to your point, interest rates are just unbelievably low. Don't know if they can get any lower because the banks have to make some kind of spread.
Agreed.
Investors, they're just not going to do loans. And the government, I mean, that's really the only way they could get any lower is if the government's buying every single loan out there at 1 or 2%. You know,
it's crazy, right? Yeah.
Yeah. So it's really, really fascinating. Now, here's the kicker. Here's what I wonder and what could create a bubble.
Okay.
Is values are extremely high because the rates are artificially low. So payments are low. Everybody's buying payments.
Absolutely.
All of the buyers we know right now are millennials, 30s.
Yeah.
You know, people in their 30s plus or minus. That's the bulk of the buyers.
We agree.
They haven't been through a housing depreciation like we have. They haven't seen values get cut in half.
Yeah.
So
certainly not as owners. Yes. They have not seen it as owners. They've read about it, right?
Yeah. If you bought a $300,000, $400,000, $500,000 house or $1 million house and you put 20% down, which you have to, unless you're a first time buyer, there's different programs out there. But let's say you put 20% down. So that's $60,000 to $100,000 to $200,000, depending on the value of the house that you've put into it. And everything's hunky dory. But then let's say rates go up and all of a sudden housing market changes, values drop. Now your house is worth 40% less. All your equity's been wiped out, but your payment is still low.
Absolutely. You gotta live somewhere. Yeah.
You have to live somewhere, but you've lost all that wealth.
Sure.
And when rates are up like that and the markets are bad and the economy's not doing great and we are in deflation, you have to look at what happened the last time. Well, it took from 2008, 9 until, you know, it took 10 years for values to come back.
Totally agree.
So the question is, How are people going to feel about that, especially ones that potentially have to move?
See now, okay, let's have this conversation. So
Yeah.
one of the reasons that the last time was clearly a bubble is once values started coming down, the debt structure, 50% of our loans were adjustable rate mortgages. So again, my belief is as long as you're employed and as long as you're working, I mean, you're going to be annoyed that your house is worth less, but you're going to make the payment because you got to live somewhere.
Yeah.
Right. But what happened last time is not only did the housing lose value, but then you had this payment shock at the 2-year mark, sometimes at the 3-year mark, where suddenly your payment went from 1,200 to like 3,200. And you're like, I do not need to live here for $3,200 because I can rent down the street for 1,800. Right. So it was that combination that led to the famous word strategic default. Given the debt structure we have today, Greg, I do not see that happening. Yes, there'll be 1, 3, 5, 7% of the people where life happens. They get divorced. They get a job move. They get something that makes them a motivated seller. Sure. That's a normal market. But we're not going to have the cascading.
Let's define what we're talking about. So
Sure.
Bubble is value.
Sure. Agreed.
Not necessarily a housing market crash or collapse. It's a value conversation. So when you say housing market bubble to me, well, that means prices are at all-time highs. How sustainable are they?
Mm-hmm.
They're only sustainable as long as the rates stay low. To me, we're in a bubble.
Okay.
That bubble could pop at any minute as soon as rates go up. That's all it's going to take.
Yeah.
Housing market is done.
No. So let's define done, because I totally agree. The variable that you must watch is the 30-year, 10-year, and then 30-year mortgage. 30-year mortgage, you get above 4%, we have a problem. They get above 5%, we're done. But now let's define what done means. In my world, done means transaction stop. Stop. I guess the only people will be buying would be cash buyers because they don't really care. They don't have interest. But basically, inventory stops or transaction stops, which means inventory swells. Because real estate's not like stocks. It doesn't change overnight. Inventory swells. And then what you're going to have, in my opinion, is you're going to have some people that don't have to move. They'll take their properties off the market. Then you will have what I love to find, the motivated seller. Motivated sellers are going to take a discount in values on those transactions that do transact in a 5% world, will sell for less. They'll have to.
So what's going to trigger all this, and why would somebody be motivated? So that's really the conversation. It's going to take some time for people to get motivated. So you don't have to sell and you have a locked in long-term rate. What I'm saying is we're done. As rates go up, values come down.
Yep.
So you bought at, today's prices.
Sure.
Rates go up. Now markets drop 20, 30%. It takes a long time for that to sink into somebody's head.
Exactly. Yes.
So
yes.
you're talking, I've seen it. I've seen it 2 or 3 times in my career where it takes a year to 18 months.
It's not overnight.
Right. So that's why inventory levels will grow, because sellers will be stuck in what they paid or what they think values are, what their tax value might be.
Oh yeah.
The
assessed value
is totally different. So it takes a while for that to wash out. So when I say we're done, that's what I mean. Sellers won't sell, inventory levels will rise, values will come down.
Totally agree.
Interest rates are up, so people can afford less house. So that's kind of what changes things. Now, I'm not saying that's going to cause there's a difference between a bubble popping in values of housing and a collapse of the housing market.
Agreed.
And like you said, the difference between now and 06, 08, 09 in the collapse is the health of the borrower and the health of the banks that have loaned the money.
Agreed.
And now the Fed's willingness, desire, and ability to prop all that up if and when it did have a problem. And you're not seeing what happened back then. I mean, so single family homes, it's a $36 trillion value in the United States. That's about the value of the houses in the United States, 36 trillion.
Damn,
that's not including condos, townhouses,
houses,
multifamily.
single family. Yeah.
Right. That gets up to 80 trillion, I think, when you add everything in.
Oh my God. Wow.
In housing. That's why it was such a big problem back then. And what had happened was all of that got levered up 100 to 1.
Oh yeah.
In terms of the way
CEOs and
these credit default swaps and, CDOs
Horrible.
and all these things were created, derivatives upon derivatives.
Yeah.
All this, it was unbelievable, how that got levered up.
The weight of that was just, it was a collapse. It really was. It was like the
were bad
underlying
loans,
asset was in, it was in trouble. So yeah, we
I
totally
don't know
agree.
what that individual is talking about. Are they talking about values? Are they talking about, the actual market itself in terms of the mortgages?
So this is essentially what he's saying, and why I have such a huge problem with it is I think you and I both agree, right? If interest rates get above 5%, the market stops and we will see a cool down, right? In talking values.
In value.
Yeah. What he is saying is it's going to pop. It'll pop by the end of this year and get out. And I'm like, oh my God, there is nothing. The interest rates today could go to 5% and the real estate market would stop, but you would not see values fall instantly. It's not a stock. It's not crypto. It's time. And again, 98% of people have fixed rate mortgages. They wouldn't care. It would take months and quarters to start. It doesn't collapse like that.
Very, very different. What happened last time was, number one, you had bad loans. Number two, you had oversupply. So you got to remember, and what this person probably doesn't know or doesn't remember or didn't experience, I don't know how old they are, there were subdivisions all over the country, especially out in Vegas, of thousands and thousands of homes that were being built on spec by developers that were vacant.
Yeah, they were building hundreds at a time. Now they do 10 at a time.
Right. So there is no housing. So we have a shortage as it is right now. You could foreclose on every house in forbearance and still you'd burn through them in probably a couple of months.
It's nothing. It's crazy.
Yeah. So it's very different in that regard. So it'll take a while to work through it. There's no way you're going to have a collapse in values or even a housing market issue by the end of this year. Just
no chance. By the end of 2021, no chance. Zero chance.
Yeah, the math doesn't work, but
just nuts.
Yeah. So it's a very different environment, very different market, very different economy. We don't have the oversupply in any sector other than commercial, and I'm talking retail, office specifically.
Agreed.
Multifamily is still undersupplied in most markets.
Yeah.
Rental housing is still undersupplied in most markets. And, there's another big fallacy out there that, like these Black Rocks and all those guys are buying up all the houses. That just isn't true. I mean, they're a very small ownership percentage of rental housing in the country. Actually, the biggest owners are private individuals like you.
Yeah, we own
rental houses. Yeah, I mean that makes up more investor ownership than like BlackRock and all those other guys.
Yeah, I've actually done the math on this because I don't like the talk track that's out there. Right, institutional buyers, which I'll plug BlackRock in and all other hedge funds, they make up about 1% of rental houses. Not so like it's 1% of a smaller number, right? So I don't know. Pretend like there's 50 million homes in America. If 10 million of those are rental homes, meaning the other 40 is owner occs, BlackRock is 1% of the smaller number. People like me, we make up over 50% of that smaller number. So they're interesting.
And again, remember what I just said, the value of single family homes right now, and it just gained 2 trillion here in the last quarter.
Yeah.
But right now,
that's true.
It's about $36 trillion. There's no way. That's more than the GDP of this country. There is no investment fund out there with that much money that can buy every house in the country.
It's just not happening. They can be if you're an investor like me and they come into your market, they could be annoying because they will overpay. Because again, they're not looking for cash flow. They're looking for preservation of capital. Their business model is different. And if they're in your market, they can be annoying, but they're so easy to beat. Big fish are lazy. They have a buy box that's this big and you just buy around them and let them help you.
And the biggest asset manager out there, I think, is it Blackstone or BlackRock? One of them. They're $1 trillion or something like that, or a couple trillion.
Yeah, BlackRock's
so again, they're $2 trillion. So if they took every dollar they had in their management and bought houses with it, they'd still only be able to buy 10% of the housing stock in the country. And they're only allocating a very, very small percentage of what they manage.
Oh yeah.
Maybe like 50 to 100 billion.
Yeah, it is. It's $100 billion. It's $100 billion they have set aside for this.
Yeah. Very small amount of money that they're allocating into housing, which arguably it probably should be more, I mean,
yeah, exactly. Watch out.
Anything else right now.
Yeah. Well, this is fun. Folks, this was a great conversation. We totally agree. I actually thought we were going to disagree, but we agree. Next one, pay attention because we're actually going to talk about some bubble markets. I do think there are bubble markets in real estate. So for the first time, I'm going to put it out there and we're just going to have a conversation. So Greg, how can people find you?
So it's gregdickerson.com. All my information is there. YouTube, podcast. I put out videos every day. I talk about entrepreneurship, real estate, investing, development. I talk about buying companies, starting companies. I talk about the economy, cryptos, all kinds of stuff.
Yeah. Do yourself a favor. Follow Greg Dickerson. Check him out. It's amazing stuff. Over 100 hours of him and I talking. Link below. Thanks, buddy.